Good afternoon. I'm Susan Weber, and joining Walker and Dunlop CEO Willy Walker today is Dr. Peter Linneman. They will discuss his analysis of the economy, COVID, return to office, GDP growth, interest rates, and more. Thank you for joining us today. And now over to Willy.
Thank you, Susan, and welcome everyone to my quarterly discussion with Dr. Peter Linneman. We had over 7,000 people register to listen to this discussion live today. And my last discussion with Peter was watched by over 110,000 people on YouTube. And it is once again great to have Peter back, particularly with so many people interested in hearing Peter's fantastic insights. As you'll hear in a moment, Peter's insights and predictions since we started doing this together have been amazingly prescient. But before I dive in to the Linneman Letter and Peter's thoughts, I want to thank the team at the Linneman Letter for all their work that goes into preparing the report. Deborah Moy is the managing editor. Mukund Krishnaswamy is the contributing editor. And there's a team of contributors and researchers who make the data and analysis of the Linneman Letter so great. I also want to thank Peter's brother, Doug Linneman, for all his help in making our collaboration so powerful. And of course, I must thank the Walker and Dunlop team, Susan Weber, Lindsay Redding, and the rest of the team for all they do to make the Walker webcast what it is. So Peter, let's back up to a year ago and run through a couple of things you got really right and just sort of right. So you said the Biden administration was new, and that, quote, if you like the policies of the Obama administration, you'll love the Biden administration because they're all the same people in this administration and don't expect much. I would say that's a check. You also said not to expect, quote, peace, love, and understanding. And I would say check, check. You said unemployment was understated and that we'd reemploy 8 million people during the year. You believe that unemployment is still understated by about 340 basis points. So you're at about a 7.6% unemployment rate versus the Bureau of Labor Statistics that's sitting at 4.2. But you were right on the reemployment levels as well as overall economic activity. So we'll go check there. You said commercial real estate cap rates would revert to pre-pandemic levels. Definitely check on multi, check on industrial, check on retail. Check sort of on hospitality and check minus on office. But I would think that you'll say, put them all together and we're back to where we were before the pandemic. You said we'd see few construction starts in 2021 other than in industrial and multifamily. Check. You said CAPN model REIT implied pricing was 17% undervalued in December of 2020. And that today the REIT CAPN implied value is 19% overvalued. So if listeners had heard you last year on this call and bought the index at 17% undervalued, they'd be up 36% between then and now. You finally said that the recovery would be like a butterfly. Butterfly isn't mentioned once in this quarterly report, which leads me to believe that you wish you'd called it the flight of an eagle rather than a butterfly. And then finally, for those who were here a year ago with us, we held this call last year on January 6th, and you did not predict that during our call, a riot would break out on the steps of the US Capitol. So that is a check minus. But other than that, Peter, incredibly insightful to the economic activity we've seen over the last year. So here we are in January 2022, and after reading your quarterly report, I'm incredibly bullish about the economy, not just for 2022, but for the next 3 to 5 years. Before we dive into the specifics on that, I want to get a couple concrete predictions from you about where we'll be a year from now. So Dow closed yesterday at 36,252. Where's the Dow on 12/31/22?
39-ish, up 8-10%.
10-year closed at 174 yesterday, has rallied a little bit today. Where is it at the end of the year?
2.6-ish, 2.5-ish.
The Fed will raise rates how many times in 2022?
They'll probably raise about 75 basis points, and therefore probably 3 times 25 bips per raise.
And come November or come this time next year, the House and Senate will be controlled by what parties?
Well, the easy prediction is it'll be controlled by crazy parties. And that's a no-brainer, right? I think on a serious note, it'll both be controlled by Republicans a year from now.
Okay. So in your report, you state GDP growth for both 22 as well as 23 of 4.5%. This economy's got some legs.
In real terms, yeah. Yeah, it has legs. And by the way, Willie, it's not like that comes out of some fancy econometric statistical model. The 4.5% is pretty simple. Think about a normal year, we would do 2.5%. We're about 4% behind where we would have been if COVID never happened. And we kind of make up half of that gap this year, and we make up the other half next year. So 2.5% plus half of 4% is 4.5%. That's the spirit of what I'm saying.
So in the Linneman report, you put a number of economic indicators in there, such as industrial output, capacity utilization, corporate profits, percent of industries adding workers, which, by the way, is incredible at over 70% of industries adding workers today. But one of the numbers that, and all of those are above trend, which is a great economic backdrop. But one of the ones that I was surprised with, Peter, is consumer confidence. And you have in there the Conference Board consumer confidence is only at 109.5 versus a pre-pandemic high of 132.6. What's the consumer missing that the economic data is telling you?
Okay, so first you have to understand, though, at 109, it's above average. So it is still above average at that number. I think the main thing the consumer is missing is the massive strength of the US economy. And I was reflecting on this the other day. What lesson did I take away from the last 22 months, let's say? What lesson I took away, and it took some reflection, is don't bet against the US economy. And I've always said that. I'm not the first to say it. But think of it this way, Willie, and then we'll end with consumer confidence. We had horrible pandemic. We had massive premature deaths. By the way, we had record drug deaths on top of that. We had political turmoil. We had social turmoil. We had the January 6th phenomena that you described. I mean, you can just go on and on of all the challenges we had. And yet, 22 months later, from the beginning of, for us, the pandemic, real GDP is 1.5% higher, which is essentially flat per capita. Industrial output is essentially 99% of what it was pre-pandemic. And you kind of go, oh my God, with all that, we were able to do that. And I think what the consumer misses is just the sheer power of this economy that it overcomes. It doesn't overcome every minute, doesn't overcome it. We invented we invented and mass distributed 3 vaccines. I mean, just think about that in 22 months from just sheer brute power. I'm not saying it's a perfect economy. I'm not saying everything it does is perfect. So what I think the consumer has is, the psychologists talk about negativity bias, right? That we like seeing negatives. We're consumed by negatives. We're bombarded by negatives. And the psychologists believe it's because evolution, the lion's coming. You better beware because if you're not, you're dead. Right. So there was a sense of negativity was information we really had to absorb, and evolution has made us overly sensitive to negative. I think the consumer is overly negative because they see the shortcomings and not the sheer power.
So if I hear that, and by the way, I parroted as much of what you just said yesterday in a call with a bunch of my colleagues at Walker and Dunlop, and somebody said, okay, what goes wrong? What's Peter think gets in the way of all this? And in your canary in a coal mine analysis, and those of you who get the Linneman Letter know what this is, but Peter goes and puts 5 canaries next to a number of different things that are early indicators for a trip up in the economy. Everything from mezzanine lending replacing equity to empty space being worth more than full space. And yet, Peter, in your quarterly letter, there are only 4 dead canaries on your chart. One is for record buyout deals, which would lead us to believe that you think that some of the frothiness in the buyout market is getting to prices that are unsustainable. And then 3 are for COVID strangling the economy. So even with what's going on with Omicron right now and the fact that the economy continues to move forward, the stock market is continuing to do well, you still fear with 3 of 5 canaries that COVID could set us backward.
Yeah, and I do believe that, and you had Mike Roizen on, and he was just fabulous. You did a fabulous job with him, and Mike would know much more than I, and he addressed this. I think that a month or so from now, one of those canaries comes back to life. And I would think that in 3 months, 2 of those canaries are back to life. And we're really moving in that regard on the COVID side. If you say to me, which your question was, is what could really derail us? I don't mention it in the last issue because it's something that's really only arisen in the last couple of weeks. Price controls. If price controls are the result of the inflation and the constant harping about inflation, right? 4 months ago, you didn't read anything about inflation, and all you read about today is inflation. 4 months ago, no congressman or no one in the White House talked about inflation. It's all they talk about. And you're starting to see this language like business suddenly got greedy and gouging, and we got to restrain them, and we've got to control prices. And I'm old enough, you're not, I'm old enough to have been an adult during the 1970s when Richard Nixon and then Gerald Ford, who were Republicans, had wage and price controls. And it was an economic disaster. You can't control prices. And the listeners know that. Imagine rent controls. Rent controls are going to make less supply available for everything. It's going to misallocate resources, et cetera. If we'd had a talk, when we talked a year ago, I didn't think there was any chance of regulatory price controls. As we sit here today, I hope there's not a high chance. But you see the same things I see, which is this increased rhetoric about we need price controls. The last thing we need are price controls. The inflation that's occurring, Willie, these high prices that are occurring are resulting from shortfalls in capacity. And the high prices are sending up flares saying, bring capacity here, bring capacity here, bring capacity here. What price controls would do is eliminate the signals of bring capacity here. And that would really harm the economy. That's what really could derail us this year. I hope it doesn't, but if it happens, it'll be a disaster.
So as we talk about price controls and we talk about inflation, you dive into the labor markets in great detail inside the Linneman Letter. And there's a recurring theme, which is that lots of elder Americans who are about
Careful, they're my age. They're my age.
They're getting darn close to my age, Peter. But given the book that you and Mike are writing as it relates to the great age reboot, you and I are both living till we're 100
years old.
You got it. So it's all good. But so in it, you say older workers who were a couple of years away from retiring, lost their jobs and have now retired and are not coming back to the workforce. But you interestingly also go to the other end of the spectrum and you look at teen workers and 16 to 19-year-olds who came into the workforce at unprecedented levels. So the number is, if I have it right, from 1948 until today, the average unemployment rate of 16 to 19-year-olds in the United States has been around 17 to 18%. And that dropped down to 10 to 11% since the pandemic. So a huge number of teenagers have joined the workforce because A, they could get jobs that they were relatively underqualified for because nobody else was there to get them. And the second is they didn't have the unemployment benefits that older workers were getting from the federal government. And then finally, they were less afraid of the virus than older workers. Right. But one of the reasons I thought your analysis of that cohort was so interesting is that there's been a lot of talk about the fact that once wages go up, you can't pull it back. So if John or Susan has gotten a raise from $15 an hour to $18 an hour, you're not going to go in and say, guess what? You're now making 16 or you're going to lose them. But you point out that that lower cohort of workers churns in their jobs a tremendous amount, so that if John or Susan is working for you and leaves, you do actually have the opportunity to reset the salary wage for the new worker coming in. You want to talk about that for a moment?
Yeah. I mean, one of the things people miss, Willy, in general, is dynamism in an economy. It's like when people talk about income distribution, they talk about the rich and the poor. Well, I was really poor when I was 19, right? I put myself through college and so forth. I was like in the poorest 10%. I didn't stay there all my life. Well, in the same way, the person you just hired for $18 an hour for a $15 an hour job, so to speak, a $15 an hour job, they're not going to stay there forever. They're going to leave and go to college. They're going to leave and get another job. They're going to get promoted. If they're a good worker, you are going to promote them. When that gap occurs and labor markets are more normalized, you'll go from 18 and their replacement will get 16 and a half. And then as it normalizes further and that person rotates out, you'll go from 16 and a half to 15. Now, plus inflation, right? And people don't understand how dynamic the labor market is, how dynamic the economy is. Things are not static. And that's how the adjustment will occur. The older side is different. Those people are gone, right? They're not coming back. But the new 66-year-old still is going to work 2 more years, right? Or 3 more years. And the new 61-year-old still going to work 5 more years. So there was a one time you just cut them off. And in fact, one of the best things, Willy, that could have happened, may have happened to the economy, I don't talk about this in Linneman Letter, is all those teens you talk about that got dragged into the labor force. They got skills earlier than they would have otherwise gotten that are going to serve them well the rest of their work life. And you don't see it so much. Well, maybe you do. You hire young people. They don't have basic job skills because a lot of them have never worked. So the good news about my era is I started working when I was 12 years old. So at least I learned you had to be on time and you had to do, and I made all the stupid mistakes and you learned it early. The bad news was you were working at 12 years old. I mean, what kind of world is that, right? So kids today, the good news is they don't have to do so much work. The bad news is they come in at 18 to 22 without those skills. That's a whole bunch of teenagers that got skills that will serve us and them well for years to come.
So in the past letters and in this one, you reiterate the fact that the consumer, if you will, the consumer pocketbook is in really good shape. We are at the lowest household debt service ratio in 40 years. Yeah. Let me just repeat that one. We're at the lowest consumer household debt service level in 40 years. And we have real checking deposits sitting at $8.4 trillion, which is $6 trillion over the trend over the last 70 years. So there's a huge amount sitting in bank accounts and there's very low debt levels. So you talk a bunch about the 3 million people who still haven't gone back to work that you'd expected to have gone back to work by now once the federal stimulus and unemployment benefits came back. If they got all this money sitting in the bank account, David, what's going to, Peter, what's going to get them back to work?
Ambition, wanting more. Actually, less ambition than wanting more, right? Years ago, I said, you do understand that all a developed, not a subsistence economy. All a developed economy is is I'll buy a bunch of shit I don't really need from you and pay you for it. And then you're going to turn around and buy a bunch of shit you don't really need from me and pay me for it. And that's how we do, right? And do I really need WhatsApp? I mean, yeah, it's good, but I don't need it. So what's going to drive them back to work is they want nicer clothes, they want a nicer car, they want a nicer home, they want a better vacation, they want their kids to have a little better pair of shoes. And everybody in the economy fits that. Everybody. And that's what brings people back. I mean, it's that simple.
So on that, just let me just jump on that for 2 seconds. So they want a job because they want there. The other thing that you point out, Peter, that I think is so important is the fact that we are yield starved. So there's a stat in the Linneman Letter, which you brought up numerous times, which I have to repeat for everyone, because until you hear it and think about the two implications of it, you forget on why commercial real estate is such a great place to be. So you put forth that 2021 personal annual interest income. So what we were getting off of bonds, both corporate as well as government, was $198 billion, or 11.3% lower than it was in 2007, even though between 2007 and today, there is $15 trillion of additional corporate and government debt outstanding. And so there are two things in that I think are so important that I'd love to hear you comment on. One is that the Fed cannot afford to let interest rates go up too much, or it can't afford to pay the debt service coverage on all of that government debt that has been issued. The second thing, though, is that the consumer is starved for yield, and they're not getting it on their checking account. They're not getting it from the bonds that they own. And therefore, a huge amount of capital is looking for a home in commercial real estate where they are getting a current yield on their investment.
And I'd finish your sentence by saying, and if you go around the world, it's true pretty much everywhere. And in fact, in many places in the world, they are negative returns. Out of the box, negative nominal returns. So your yield starve is true. Think of it this way, Willie. Go back, 15 years ago, Treasury was at 4.5, inflation was 2.5. I could get a 2% real return out of the box by buying a government bond. Now, it may end up worse or better depending on how inflation plays out, right? But at least I thought I had it. Today, what is it? I don't know what it is today, 1.7%. And inflation, even if you believe, as I do, that it normalizes back down to 2.5%, it's a negative real return. I don't have a fighting chance of making money. And in fact, if inflation is 7% this year, and I'm getting 1.7%, what is that? That's 5 years. 5 years of income just gone, right? In terms of trying to keep up with inflation, right? Just gone. My only chance of making a return is the last 3 years on the bond, if you will. So what is real estate given that world? And by the way, stocks given that world, a fighting chance. At least I have a fighting chance. The investment I make in real estate may go wrong. I may lose money. I may not do great. I may do great. I at least have a fighting chance. You don't have a fighting chance in the bond market. You just don't have a fighting chance. So if there are most people want at least a fighting chance. So it's more dramatic than I think even you were implying. It's not only the relative return is higher. It's not only is the relative return is higher, it's the only place I got a fighting chance to get a return.
So all those deposits sitting at banks have made banks way over deposited. And you state in the Linneman Letter, banks are awash with liquidity, which we believe will ultimately come out chasing assets. This will cause stock multiples to expand and cap rates and bond yields to fall over the next 3 to 7 years.
Yeah. And the only thing is, I can't be much more precise in timing, because what I don't know is how fast the Fed, from a regulatory point of view, stress tests in particular, I don't know how fast they'll let them have some of that money come out. And as you know, there's record amounts of money in the system. And I just believe a fair amount of it comes out over that time period you said. And when it comes out, it will chase assets more than goods and services, because the modern banking system is set up to lend to the businesses that are listening, right? It's set up to make large loans. Yes, they make credit card loans, but they make loans on houses. That's assets. They make loans on cars. They make loans to asset buyers. And asset buyers buy assets from asset owners who turn around and buy more assets, right? And so it really, I think, we saw this from 2014 to the pandemic beginning. Cap rates went down, multiples went up, by and large went up. Cap rates by and large went down. Why? It wasn't random. It was not random. And when my research would indicate, I don't want to make it sound like it's definitive of all time. My research would indicate that statistically, as well as intuitively, the weight of money determines cap rates and multiples. And the intellectual experiment I do, and I think we republished it in the current Linneman Letter, the intellectual experiment is real simple. If I told you a year from now, twice as much money will be invested in commercial real estate as is currently invested, what will cap rates look like a year from now? And the answer is massively lower. We could argue about how much lower, but massively. Now, I'm not saying we'll have twice as much money. My point is, it drives home the intellectual point. It's not about what the interest rate is. It's not even about what inflation is. If you've got twice as much money chasing it, it's going to bid up prices, which is lower cap rates.
So I want to, on that, I was going to talk about this in a little bit, but I want to read something from the Linneman Letter that I think is really important for listeners to hear, where you state, we continue to believe that the real opportunity today is to underwrite cap rates falling over time due to the eventual weight of QE infinity lending. Unprecedented money in the system leads to unprecedented pricing. You go on to say, we expect a repeat of the asset price inflation we witnessed from 2013 to 2019. And finally, to try and send that message home to your readers, you write, despite the historical precedent to the contrary, we also expect a second decade of buyers thinking, quote, surely cap rates will go up, unquote, even as they compress.
Yeah. And by the way, I was one of those people a decade ago, right, who was saying, can't last, can't last. And it kept lasting, right? Cap rates kept coming down, cap rates kept coming down. And I started going, what's going on? And I really started looking at the data. I really started thinking about it. And I realized, just take, for example, I know you know this, in 2007, cap rates were essentially the same as in 2019, right? Just as roughly. Right. And yet in 2007, interest rates were above 5%, both on the long and the short. And in 2019, they were both basically below 3%. Right. Well, if interest rates are determining cap rates, how did that occur? Right. Well, what did they have in common? It wasn't interest rates. What they had in common was a lot of money chasing, a lot of money chasing. I don't mean that in a bad sense. If money is put in the system, it chases. And so when you, and I am a Milton Friedman student, and so when you put in a lot of money, whatever it chases will go up a lot in price. And what it chased in the 70s tended to be goods and services and assets. Okay, goods and services and assets. What it chased in the 2013 to 2019, and I think we'll chase again, is assets and goods and services.
So you calculate that the banking system today can lend $39.9 trillion as of October of 2021. And that's up from a previous record of $25.8 trillion. So you got $14 trillion of additional lending capacity sitting in the banking system today. Does anything get in between that money being in the banks and getting out to businesses and assets and out into the economy?
Yeah. From a true regulatory point of view, they could lend what I say. What keeps them from lending it, and what kept them from lending all of it back in the 2013 to 2019 window, was stress tests, which are not statutory, but they are regulatory. And they kept banks from doing it because you had to pass stress tests. Now, did you literally have to pass a stress test as a bank? No. It's that if you didn't pass a stress test, right after the news in the newspaper was you failed your stress test, you would have to go out and raise more capital. Right. Well, that's unappetizing as a scenario, right? So what they never stopped the banks from lending it. What they did was say, but if you fail the stress test, we're going to make you raise capital right after telling the world we think you aren't safe. So the banks kind of tiptoed around and avoided and tiptoed around and pushed the envelope and pushed the envelope, and they kept lending more and more as long as they could pass the stress test. So what's keeping it in is the stress test. And what will keep it in a bit longer are stress tests. And remember, the Fed changes the stress test parameters all the time. And right. As a bank, you don't know what those parameters are. You simply know if you fail or don't fail. And the punishment is big if you fail. It's a little like saying, Willie, I'm not going to tell you what the tax laws are, and I'm not going to tell you what the tax rates are. But on April 14th, you've got to pay your tax bill. And if you underpay, there's going to be a big penalty. Right? That's what it amounts to. And it's not the greatest regulatory model, truthfully. And it probably reflects the fact that the Congress could never come up with a real regulatory program to make it happen. So that's where we are.
So in a rising interest rate environment and with the banks fully overfunded, if you will, owning bank stocks, good place to be? Just a quick question. Yeah. We don't need to go into that in great detail, but it sounds like bank stocks are a good place to be.
They'll get more business. They'll get it at higher rates. They can offset their overhead better. I don't think rates go up huge. Their spreads will narrow a little, right? Normally when interest rates go up 100 bips, you're the expert. If I told you the base rate went up 100 bips, and the economy is good, spreads will absorb 20 bips of that, probably lending spreads historically, 10 bips of it. So it doesn't fully translate. So yeah, I think banks are a good place to be. They got free money, for God's sake. Wouldn't you have liked to have been given what the Fed gave to the banks? Yeah. Now, they gave it to them with a lot of restrictions, right? But my God, they gave them stunning amounts of money for free.
So talking about getting a lot of money for free, we also have the American consumer who is sitting on a ton of money. As we said, there's almost $9 trillion sitting in banking accounts across the country that consumers have access to. One of the things that you were very prescient on was the fact that brick retail was not dead. And that even though all of us thought that Amazon and UPS and FedEx delivery trucks were the only retail we were going to see for the rest of our lives during the lockdown in the depths of the pandemic, you continued to say brick and mortar retail is not only not dead, it is thriving. And if you look at the brick retail numbers for the month of November 2021, brick was $525 billion, 14% above the pre-COVID peak of $460 billion. And to add to that picture of historically high brick retail numbers, E-commerce in Q3 of 21 dropped down to being only 13% of retail sales. And so it had gone almost up to 20 and then now came back down to only 13% in Q3. What's your outlook for e-commerce and brick retail going forward, Peter?
So I think e-commerce, if you look at it as a percent of non-auto related retail, I think the trend continues at least another 5 years. And it is an increasing trend, right? I did the math. I think it's something like 40% of incremental real retail sales growth goes to online. Think about it. They have 15% of overall sales and they're getting 40% of incremental. So I think that continues, but basically 6.5 out of every $7.5 of retail go through brick. And the fact that online is growing faster than brick doesn't mean brick isn't growing. And the best thing that happened during the shutdown and during the pandemic to good retail is it pushed a whole bunch of bad retailers out of business. And it pushed a bunch of bad retail centers out of business. Now, why is that good for good centers? Because it means those sales are going to go through them rather than some poor retailer who stumbles and stays alive. The capture is better. That's competition at work. So in an odd way, obviously it was painful to go through for everybody, but very few of the major bankruptcies or the major go out of business that you saw in retail during the pandemic, most of those retailers were going to go out of business anyway in that next 2 or 3 years. It's not unlike those the baby boomers. They were going to retire in a few years. Most of those retailers were on watch lists and were on death's door. And all the pandemic did was speed up the death for those businesses. If you had strong retail, it meant you got your space back, and as the economy picks up, you'll rent it out to a more viable retailer. A lot of work, a lot of brain damage, a lot of risk, but you'll end up with a stronger center if it's a good center. The bad centers are struggling. That's what competition should have happened, right? Which is bad centers should struggle and die. It's unfortunate, true.
When people...
Milton Friedman had a wonderful statement once. I remember sitting in his class, and Milton had this statement: any system, any economic system can create winners. Communism, cronyism, any system can create winners. Only capitalism can fairly create losers. Right. And we need losers.
So as people are spending money at the malls, they're also spending increasing amounts of money on oil and gas. So let's talk for a moment about oil and the price of oil. You make a comment at the beginning of this quarterly letter that Western economies are, quote, sabotaging their recovering economies at the global warming altar, unquote. And I was in New York last month with JP Morgan's chief economist, Michael Semblist, and he made a similar comment saying that government regulation was pulling back exploration and extraction of fossil fuels long before our economy's need for fossil fuels is reduced sufficiently, which is setting up a classic supply-demand imbalance, which is going to drive oil prices up precipitously. And we've got right now oil sitting at around $65, $67 a barrel.
Yep.
Given what you said at the beginning of the Linneman Letter and where oil is today, Peter, what's your projection for the cost of crude over the next 2 to 3 years as we have this supply and demand imbalance coming into our economy?
So oil, my number one projection is it'll be volatile. And if you look at the history of oil, it's a very volatile phenomenon. And that will continue. If you look, I think I go back to 1960 and calculate the real price of oil. Today is just slightly above the real average with tremendous volatility around that average. So by historic standards, it's not that high. You add to it that for the United States, we're roughly oil neutral. We import some, we export some, we're roughly. So different parts of the country are not neutral, right? Houston benefits from high levels and other places lose. So I think we'll see a lot of volatility, and that volatility will be between about $60 and $80 a barrel. And you say, well, that's a big range. Not compared to the historic volatility, that's not a big range. That's the nature of that asset because it's political, it is expirational. It's not going to derail the economy. It's not going to derail the economy. And in fact, it'll help parts of the economy. It'll hurt other parts. My comment about sacrificing at the altar of climate change actually is really true in Western Europe. Really true in Western Europe. They're doing crazy stuff. And they've been doing it now for 5 years, and their energy prices are showing it. And it's not that, quote, something shouldn't be done. It's you don't need to do it all now. This is a long-term problem that's moving very slowly. We can deal with it very slowly. We're going to innovate and so forth. It would be as if you were, by the way, in all likelihood, you're going to have cataract surgery at some point in your life, right? In all likelihood. But don't go get it done now, right? That would be stupid. It is going to be a problem. Take care of your eyes in the meantime. And yes, you will get a vision reboot from cataract surgery, but there's risk of surgery, right? You don't want to do needless sooner than you have to. By the way, you certainly aren't going to take a 20-year-old and go get them cataract surgery and put in artificial lenses. That would be stupid. You'll deal with it as the time comes. And, a la what you talked about with Mike, time is on your side medically. Mike, that was one of Mike's points, right? Time is on your side. Let the advances occur. Let the innovations occur. Don't do them prematurely. Let the innovations occur and take advantage of the innovations. That's why you wouldn't do cataract surgery today, right? Because they're going to get better at it. Maybe there won't be surgery. Maybe it'll be genetic, right? Maybe it'll just be a pill. Wait and see when you're 68 or 70 and have it done. So it's not that you won't have it done. It's not that it's not a real problem. There's a time to react to things, and you want to have innovation, have as much time and opportunity as it can before you force an artificial decision.
So you reintroduced in this quarterly letter your MSA alpha beta analysis, which you haven't done in quite some time. And it's a fantastic view of varying markets in the United States and where we are seeing economic growth and where economic growth is tied to the broader growth of the economy and where economic growth is, if you will, not that directly correlated. And the beauty of the analysis, at least from my perspective, Peter, is that you go through and look at those cities that have alpha, where if the economy is flatlining as it relates to job growth, they are creating jobs on their own. And then there are those cities that have what you look for in a low beta, so that when we go recessionary, they lose the least number of jobs. Easy way to look at that is Washington, D.C., because it's got the government establishment. It's not going to lose that much employment during a downturn. And your analysis of the alpha and the beta, I think, is so interesting because you go through and look at the high alpha markets, the low beta markets, and then you find that crossing point where you can sit there and say that's got kind of the perfect mix of uncorrelated job growth. And yet at the same time, when the economy stops, it doesn't stop like Las Vegas did during the pandemic, where the only reason that Vegas grows so fast is because of entertainment. And the moment entertainment goes away, Vegas falls really hard. Talk for a moment about what that analysis told you as it relates to kind of the best places to invest in America today.
Yeah, I mean, I think it's on page, don't hold me to that. I think it's on page 59 of this issue. Are these alpha betas, and 60 shows the break points that you're talking about. I think what it really says is that if you're bullish on the economy for the next 6 or 7 years, which I am, I think, by the way, if we'd have held this session 2 years ago, literally 2 years ago, before the pandemic was known, you heard this little stuff in China, right? But before it was really known, all of our conversation would be, when are we going to go down? When are we going to go down? When are we going to go down? Right?
So buy low beta. So buy low beta markets. Right.
You buy low beta. Right. So what happened was the shutdown, the COVID, et cetera, we got to reset, right? We got to reset. We wiped out lots of the weak players. We wiped out a lot. We re-injected. We got a new baseline for another 7 to 10 years, right? And of growth. And we have runway. We already talked about it. We have runway. We have capacity to build back. We have labor that's not fully employed. Our manufacturing is not back to its previous peak, et cetera. Okay. My view then says the US economy is in for a real good next 2 years and probably a good next 7. That would suggest to me, I'd like to have high alpha because I'd like to have growth if I'm wrong. But I'd also like high alpha, and I'll take on the high beta, at least for a few years, because I really get turbocharged by that. So the Orlandos, the Atlantas, I'm doing off the top of my head, the high betas, Vegas, high beta. I would take those on as long as I'm going to invest for 5, 6, 7 years, because I think you're in that growth window. And you say, that's where I think you can get a lot of growth. Now, you're also going to get a lot of supply there. So just because you get growth, you get a lot of absorption, but it doesn't mean you don't also get a lot of construction. But that's the way I use it, is the alpha. When I'm feeling defensive, I want high alpha and low beta, which is Washington, D.C., for example. When I think I've got a lot of runway looking at for growth, I'd always like to have good alpha, but beta.
And so one of the other things you state in the letter is that a good single family housing market and a good multifamily housing market are not mutually exclusive. And you give some really interesting examples about things that work together to create more supply and a bigger market. But one of the big issues you also focus on is housing affordability. And if you look at the price appreciation that has occurred in the single family market, you point out that the median home price of existing stock is now at almost $354,000 in November of 2021, up 14% from the previous year. And that new construction home prices are even higher, with new construction homes hitting a median price of $416,900 in November. And I read a data point outside of your letter, Peter, that was talking about the fact that a year ago today, 30% of the housing stock being developed was at a price point of below $300,000. And today that's dropped down to 13% of homes being developed today are below $300,000. And so it's very evident that in the single family housing world, entry-level single family housing, either existing or to be built, does not exist. And so anyone who is hoping to jump from rental to the housing market can't do it. And yet at the same time, you also talk about the fact that right now on the multi side, we are just slightly above trend as it relates to new deliveries of multifamily, which says to me, it's sort of a perfect world for home builders and for owners of multifamily, in the sense that the home builders are building to a higher price point and probably making higher margin on a per unit basis on selling those homes at $450,000 rather than $350,000. And because there is such a delta between rental and single, and people can't get into single, and there's limited supply on the multi side, that owners of multi can continue to push rents. Is that a proper summary?
You got it. I mean, there's a fundamental shortfall of production of housing in the United States, particularly in some micro markets, really fundamental shortfalls. And prices go up. I mean, this economics isn't that hard. If supply lags demand by a good amount, prices will go up. And that's what's happened. And it's happened broadly, not every market, not every sub-market, but broadly. And it's happened for some time. It's not just been the last year. Yes, the last year has been a big surge, but home prices have been outstripping and rents have been outstripping inflation now for the better part of a decade, other than during the blip of COVID, the down blip of COVID. And that's because of the fundamental underproduction. And the fundamental underproduction of single family helps multifamily. How? It helps because, yes, the monthly is higher, but that monthly is going to be higher in multifamily as well. But it makes the down payment harder. Think of the down payment on a $300,000 home versus a $400,000 home, or a $200,000 home versus a $400,000. You just eliminated a lot of people who don't have enough savings. By the way, Harrison Lefrak sent me something yesterday that I was unaware of, which is, and Harrison, if you're listening, I apologize if I don't get the data right, but there was a recent survey that says something like 20% of all first-time home buyers are using crypto, are cashing out crypto. And you think about, these are young people and they're into crypto as what they're using to get ready to buy their home. Is a little nuts, but put that aside. But it just shows that they're wagering, if you will, hoping to get a down payment. So the down payment is the real issue. And in fact, I know you and I have spoken about Ivy Zellman, and I have a lot of respect for the work she and her team do. I mean, they're very thoughtful people. And I think on one of your shows, she argued that we're heading to a period, not that we're in a period, but that we're heading to a period where we'll have overproduction. And someday we might, but not now. And when people say, well, how do you square your underproduction with Ivy Zellman's statement that we've got overproduction? First of all, she, at least as I hear them, they don't say we have, they're saying we will have at some point. And that's a big difference. My proof of underproduction, by the way, Willie, is for the decade, single-family home prices have outstripped inflation by a good margin, and multifamily rents have outstripped inflation by a good margin. That doesn't happen if you have too much supply.
So let's shift in our limited time left to office and retail, because I was very surprised with something you wrote in the letter, Peter, which was retail and office rents will show improvement in the first half of 2022 and really pick up steam in the second half. And you predict that 35 of your 46 tracked office markets will be back in balance by the end of 2023. What are you seeing in the office market that I am not?
Well, it all depends on, do people come back to office, right? It's that simple. If I told you by June, 80% of the people are back in the office.
I don't think 80% of the people are going to be back in the office by June.
But that's what I
think that your 2023 number is wildly optimistic.
That's what I'm seeing. The simple answer to your question is, I think people come back. And I think in an odd way, Omicron is going to speed that up because so many people have gotten it. So many of people have gotten it mildly. I had it. My wife had it. Mine was like a flu for 4 days. My wife's was like a cold for 4 or 5 days. Not fun. I'm not trying to say go get it as a result. But now you have natural immunity in addition to boosters, and we got the antibody infusions. I'm just swimming in antibodies at this point. I think the fact that so many people have gotten it and they've known people who've gotten it has said, okay, what's my excuse for not going back to the office? Willie, I've been working remotely almost the entire time because I didn't want to be around people. Now, from all the epidemiological, the chances that boosted and just over a bout of COVID, the chances that I would get COVID in the next 5 to 7 months are really remote. Why am I working remotely? Right? Why? Well,
it's convenient.
I don't have a real risk.
It's convenient. That's my big issue.
It's convenient.
I think that at least, from my standpoint, I was pushing really hard to get back to the office by September and Labor Day, and then Delta hit and we pushed it back. And look, I'm going to visit new office space on Monday. And I'm not sitting there saying we don't need a new office in Denver, Colorado. Okay. So I'm committed to having office space, but I'm also right now very much in a wait and see mode as it relates to how much office space people need and how they want to use it. Because I think exactly what you were just talking about, Peter, is at the crux of the matter, which is just that you're not in the office because you're fearful of the virus. You're not in the office because it's more convenient to work from home. And so I think that this hybrid model that we're seeing just puts a big question mark, not whether people are going to continue to use offices, but how much and how much space they need.
Okay, so let me give you my anecdotal argument for people come back to office. One of the most popular TV comedies, both in the United Kingdom and the United States, was The Office. The two variants, Ricky Gervais's two variants, the US. Dunder Mifflin was the US. I can't remember what the UK was. Right. And one of the reasons, besides they were well written, one of the reasons they were so resonant is that everybody knows what it's like to work in an office where all that people do is figure out ways to screw off, including upper mid-level management, right? Upper mid-level management find ways to screw off. That was the whole premise of the show. And we all looked at it and go, oh yeah, that's Tim. Oh yeah, that's Barbara. And that was part of the joke. That was Ricky Gervais's great insight. Now, imagine Ricky Gervais writing the Home Office comedy. If it looked like that when they were there and some sense of discipline and some, what do you think Ricky Gervais's comedy series Home Office looks like? And don't you think whole lots of people recognize it when he writes that show? That's my argument. My argument is simply a productivity. Convenience. It was never convenient to go to work. It was productive to go to work. So what I would do is say, every listener who thinks they won't go back to the office, go watch a few episodes of The Office. And then ask yourself, what is Ricky Gervais's version of the Home Office? And I think you're going to get your people back.
All right. So I will say just one quick thing, which is that I had never gone on a cruise before, but had watched The Love Boat my whole life and still figured out how to find love in my life. So I would only say that you don't have to have worked in an office to have some humor both at home and on the office. But before we completely run out of time on this one, and I love this debate, you interact with a huge number of extremely well capitalized, extremely smart real estate investors on a very consistent basis. Where's the smart money going right now?
I would say it's starting to come off the sidelines. A year ago, it was still largely on the sidelines, figuring I don't have to hit a home run. I'm happy to hit doubles and triples. I think it's starting to come off the sidelines. It's going to industrial because there's a lot of growth potential there. We've talked before about the 3-to-1 factor, and I described that again in Linneman Letter. Multifamily because of the fundamental underproduction. Single family rental because of the fundamental underproduction. Still not back to office because of exactly our debate. I think coming back to good quality retail, really good quality retail coming back. And I think good hospitality, it's coming back to. I think it's still questionable about weaker hospitality, but if I have the better stuff, at least in the major food groups, development is pretty much still industrial, multifamily. It's it's occurring there with smart money. And if I had to say one, my description of, if you were to ask me what is the year 2022 going to be known by at the end of the year, it's going to be the year of normalization. It's going to be the year of normalization of jobs. It's going to be the year of normalization of health. It's going to be the year of normalization of going back to the office. It's going to be the year of normalization in a lot of things, right? Not 100% normalization, but normalization. And
So
that's what I think people are betting on. I think the smart money is now starting to bet on normalization.
And U.S. versus foreign, thought that U.S. is going to have herd immunity quicker.
Not a lot of people.
Better. Do you stay home right now? You don't go abroad. You don't go chasing
well,
deals
you don't
abroad,
go to Mexico. You don't go to Mexico. You come from Mexico because that's not looking good. I don't think you want to go to the eastern Ukraine. I don't think you want to go to Russia. I don't think you want to go to Afghanistan. China, yeah, I don't. So I think the U.S., with all its problems, is the most attractive place. And you say, well, what about other places in Western Europe? We touched briefly. They've got a disaster on their hand with the energy stuff. And they just tried to do too much too soon, needlessly tried to do too much too soon. They're not going to collapse, but it's a problem. So, by the way, I would include Canada when I say, I know Canadians get upset when we say it's like the US, but I would include Canada as an attractive. They're smaller places. The US is an attractive place. And even with all our problems, I go back to what I said to start with, Willie. If the US could weather all it's just done and be where it's at, I want to be there when it's not facing all that crazy stuff.
And with that as the last word, Peter, once again, thank you. Fantastic. Thank you, everyone. We had a huge audience today. Greatly appreciate everyone tuning in. I'm back next week with tennis legend Jim Courier, live from the Australia Open, talking about everything from professional tennis to what's going to happen to Novak Djokovic and whether he's going to stay in Australia or come home. Peter, thanks. I hope everyone has a great day and take care. We'll see you next quarter.